Assalamualaikum and a very good day to Semua Raden Purak. This is an honor for me and my fault to present about our group project for subject FAR670. We have chosen two companies, that is Seng Plantation Holding Berhad and IOI Corporation Berhad. Before we proceed, let me introduce our group member first, which is NORASYIKIN binti SINGKE, SALHA bin ABDUL Salam, NETTY REZUANNA ISMAIL, AWANG ISYAMUDEEN bin AWANG MOHD, and me, ROSHAHIZAN binti Muhammad REJAB.
Background of Seng Plantation Holding Berhad. Seng Plantation Holding Berhad are founded 38 years ago in Tawau, Sabah. Seng Plantation Holding Berhad was started as a shop in 1946 under the name Seng. Seng is mean unity and success. This company expanded into the timber business and thereafter rubber, copper, and oil palm plantation with the incorporation of the River Estate Limited in 1950. Seng Holdings Berhad was incorporated in Malaysia as a private limited company on 18 April 2007. Before it was converted into the public limited company on the 3rd May 2007 and known as Seng Plantation Holding Berhad. Seng Plantation is an oil palm plantation company listed on the Bursa Malaysia and is one of the largest producers of sustainable palm oil in Sabah. Dato Muhammad bin Haji Chief Hussein is the independent and non-executive chairman of the Seng Plantation Holding Berhad and was appointed to this position on 31st May 2019. Financial accounting period year end on 31st December. Seng Plantation Holding Berhad mission to achieve optimal productivity and to be the most cost efficient in Malaysia. The independent auditor of this company for the year 2020 is KPMG, Lee Hen Kok, who assigned the audit report.
Background of IOI Group of Companies. IOI Corporation Berhad is a leading global integrated and sustainable palm oil player. They are listed on the main market of Bursa Malaysia Berhad and trading as Mixed 1861. It was incorporated on 31st of October 1969 as Industrial Oxygen Incorporated Sdn Berhad. IOI is one of Malaysia's biggest conglomerates. It ventured into property development in 1984, which later on followed by oil palm plantation and refineries in 1985. Their resource-based manufacturing business consists of three segments, that is refining, oleochemical, and specialty oils and fats. Their downstream products are exported to more than 60 countries worldwide. Thank you.
Assalamualaikum to Semua Raden Purak, our respected lecturer. My name is NETTY REZUANNA binti ISMAIL, and I will be reporting to you the SWOT analysis of Seng Plantation Holding Berhad and IOI Corporation Berhad. SWOT analysis is a framework used to evaluate the company's competitive position and to develop strategic planning. The SWOT analysis provides key insight into both internal and external factors that can impact the performance of an organization. It can help the management of the organization to optimize performance, look for new opportunities, manage competition, maximize return on resources employed, and minimization of various business and policy-making risks. The SWOT analysis for Seng Plantation are: for the strength, there is success of new product mix. Seng Plantation provide exhaustive product mix option to its customers. It helps the company in catering to various customer segments in crop industry. Number 2 is brand catering to different customer segment within crop segment. Seng Plantation extensive product offering have helped the company to penetrate different customer segments in crop segment. It also helped the organization to diversify revenue stream. Number 3 is first mover advantage in the increasingly crowded marketplace. The new products are rapidly increasing Seng Plantation market share in the crop industries. Number 4, market leadership position. Seng Plantation has a strong market leadership position in the crop industry. It has helped the company to rapidly scale new product successes. Number 5 is wide geographic presence. Seng Plantation has extensive dealer network and associates network that not only help in delivering efficient services to the customers, but also help in managing competitive challenges in crop industries. Number 6 is diverse revenue models. Over the years, Seng Plantation has ventured into various businesses outside the consumer or non-cyclical sector. This has enabled the company to develop a diversified revenue stream beyond consumer or non-cyclical sectors and crop segments. Now we come to IOI Corporation Berhad SWOT analysis. For the strength of IOI Corporation Berhad, there is development of agri-science technology. This improves crop and oil yields to meet increasing global demands. The second one is integrated business model, from plantation to specialty fats and oleochemicals. The third one is operates on a multi-scale stakeholder format, which involves strict principles and criteria covering the social and environmental requirements for the production and use of sustainable palm oil. The fourth one is crude palm oil prices have trended higher and are relatively stable year on year, supported by the growing demand for vegetable oils as well as emerging demands from the biofuel sector. And the last one is the variation of employees. Employs more than 30,000 personnel of more than 23 different nationalities in 15 countries bring more experience to this company and make them become efficient.
Assalamualaikum to Semuradin and all. My name is NORASYIKIN binti SINGKE and I will present for the part of SWOT analysis weakness. So first for Seng Plantation dan Berhad, the first weakness is high turnover of employees at the lower level. It can lead to high salaries to maintain the talent within the firm. Niche market and local monopolies that companies such as Seng Plantation able to exploit are fast disappearing. The customer network that Seng Plantation has promoted is providing less and less effective. The second weakness of Seng is gross margin and operating margin, which could be improved and going forward may put pressure on Seng Plantation financial market. Declining per unit revenue for Seng Plantation, competitive in the industry name, is putting downward pressure on the profitability. A starting guide to manage this situation for company name is objectively assessing the present value proposition of the various products. The third weakness is extra cost of building new supply chain and logistic network. Internet and artificial intelligence has significantly altered the business model in the consumer or non-clinical industry, and given the decreasing significance in dealer network, this can be extremely expensive. And the last one is low investment into Seng Plantation customer-oriented services. This can lead to competitors gaining advantage in the near future. Seng Plantation need to increase investment into research and development, especially in customer service-oriented application. As for IOI Corporation Berhad, their weakness are uncertainties, manpower, and palm oil industry. So the first is uncertainties, which is in the form of commodities price risk, credit risk, foreign exchange risk, and interest rate risk. This is the weakness of IOI Corporation Berhad in managing their company. The second one is manpower. Constraint pressure on increasing operation costs and extremely weather in the plantation division. So the last one is palm oil industry. These industries faces a huge number of unresolved land conflict due to land grabbing.
Assalamualaikum warahmatullahi wabarakatuh. To our lecturer, Sir Muradin Purak, and all my friends. My name is AWANG ESYAMUDEEN bin MOKTI. Today I want to present my part, a part of SWOT, that is opportunity of Seng Plantation Holding Berhad, a part of leverage ratio, and a part of efficiency ratio. For the first, SWOT analysis. Seng Plantation SWOT matrix, weighted SWOT analysis. The opportunities are: first, increasing government regulation; two, trend of customers migrating to higher end products; 3. Increasing customer base in lower segment. 4. Accelerated technological innovations in advance. 5. Local collaboration. 6. Lower inflation rate. And 7. Last, changing demographics. And opportunities for IOI Corporation Berhad. First, demand for palm oil. The demand for palm oil would remain strong as consumption increases in select emerging economies coupled with the general global population growth. Second, expansion. Expansion of palm oil industry expand throughout outside Malaysia due to the scarce sources. For example, Indonesia is rich through the acquisitions of interest in oil palm estate. The third, emerging biofuel market.
Threats. Threats are factors that can be potential dangers to the firm business models because of changes in macroeconomic factor and changing consumer perceptions. Threats can be managed but not controlled. For Seng, we have found 4 threats. That is, 1. Trade relation between US and China can affect Seng plantation growth plan. This can lead to full-scale trade war which can hamper the potential of Seng plantation to expand operation in China. Number 2, competitive pressures. As the new product launch cycle and reducing in the consumer or non-cyclical industry. It has put additional competitive pressures on players such as Seng Plantation. Given the large customer base, Seng Plantation can't respond quickly to the need of the niche market that disruptors are focusing on. Commoditization of the product segment. The biggest challenge for Seng Plantation and other players in the industry is the increasing commoditization of the product in consumer or non-cyclical industry. Number 4, shortage of skilled human resources. Given the high turnover of employees and increasing dependence on innovative solution, company name, and face skilled human resources challenges in the near future. For IOI Berhad, we found 3 threats. First, economic crisis in the Eurozone and the global economic slowdown result in lower global trade and investment. Number 2, in the refinery and specialty fats sub-segment stiff competition posed by the Indonesian resource-based manufacturer which have a cost advantage due to Indonesia's preferential export duty tariff structure. Third, unfavorable legislation and government policies are constant threats. In this presentation, we will be covered about the profitability ratios, efficiency ratios, leverage ratios, liquidity ratios, and market ratios. Now, I want to present about the profitability ratios. Profitability ratios measures the company use of its asset and control of its expenses to generate an acceptable rate of return. There are 5 elements in profitability ratios, that is, operating margin, profit margin, return on asset, return on equity, and asset turnover ratio. Now, let's take a look roughly what we have found in profitability ratios for the 2 company in 3 years. I will not elaborate in detail due to time constraints. For Seng Berhad, we can see that it is an arising in all ratios from 2018 to 2020. Although the number increase do not so high, but it can be said that the company is doing well even though in tough condition in 2020 in economic pandemic COVID-19 recession. Otherwise, for IOI Berhad, it started with a boom in 2018 but slowly decreased in 2019 and also dropped significantly in 2020. This is due to less revenue earned in present year. However, profitability ratios will vary between and within industry due to competitive force, economic condition, use of debt financing, and operating characteristics such as a high fixed cost.
Debt ratio. A company's debt ratio is a measure of the extent of its financial leverage. It can be interpreted as the proportion of a company's assets that are financed by debt. Based on the ratio above, it clearly shows that Seng Plantation Holding Berhad has more favorable ratio as compared to IOI Corporation Berhad. It showed that Seng Plantation Holding Berhad has more stable business with potential of longevity because the company has lower ratio and has lower overall debt. From the comparison, we can see IOI Corporation Berhad has a higher value of debt ratio than Seng Plantation Holding Berhad. A high debt ratio can put IOI Corporation Berhad at risk for a serious financial crisis, including bankruptcy or property foreclosure. Debt to equity ratio. The debt to equity ratio shows the proportion of equity and debt a company is using to finance its assets, and it signals the extent to which shareholders' equity can fulfill obligation to creditors, and in the event a business declines. Based on the table above, IOI Corporation Berhad a higher ratio than Seng Plantation Holding Berhad, which indicates that company may not be able to generate enough cash to satisfy its debt obligation. As for Seng Plantation Holding Berhad that has lower debt to equity ratios indicate that a company more financially stable business. For Seng Plantation Berhad, the debt to equity ratio in 2018 is 26.34% and increased 29.36% in 2019. However, the ratio decreased in 2020 to 27.24%. Meanwhile, for IOI Corporation Berhad from 2018 to 2019, the ratio was decreased, but it increased back from 2019 to 2020. The ratio was decreased, but it increases back from 2019 to 2020 at 73.49% to 74.82%. A higher ratio in debt to equity ratio of IOI Corporation Berhad, it might be due to investors don't want to fund the business operation because the company is not performing well. Lack of performance might also be the reason why the company is seeking out extra debt financing. Companies with a higher debt to equity ratio are considered riskier to creditors and investors than companies with a lower ratio.
Okay, next, under the leverage ratio is time interest earned. So, time interest earned is the ratio that indicates the company ability to pay off its interest expense with available earning. So, for Seng Berhad, in 2018, we didn't find the interest expenses. However, in 2019, the time interest earned is 44.75%. An increase in 2020, which is 77.61%. This means the ability of this company to pay off its interest expenses become more better over year. As for IOI Corporation, the time interest earned for 2018 is 9.41. And in 2019, the time interest earned declined to 5.27, and again they declined in 2020 again to 3.66. So IOI doesn't show a better performance in the ability to pay off their interest expenses with their available earnings. Next ratio for this industrial analysis is liquidity ratio. So the first ratio under this liquidity ratio is current ratio. Current ratio used to measure a company abilities to pay their short-term obligation or those debt that due within 1 year. For Seng Plantation, the current ratio has slightly decreased for the last 2 years based on this table and highly increased in the third years, 2020. The company, however, still show a good abilities in paying the short-term obligations since their current ratio is greater than 1. As for IOI Corporation Berhad, the current ratio had increased for the last 2 years and then decreased in the third years. However, this company still have a good current ratio as well as Seng Plantation since they also have a current ratio which greater than 1. Both of these companies can quickly pay back their debts and the company are at good financial health. Seng is more favorable based on the whole ratio to creditors rather than IOI and Berhad.
The next one is acid test ratio. The acid test or quick ratio compares a company's most short-term assets to its most short-term liabilities to see if a company has enough cash to pay its immediate liabilities, such as short-term debts. The acid test ratio disregards current asset as the difficult to quickly liquidate, such as inventory. An acid test ratio of 1 or above is considered good. When the ratio is at least 1, it means a company's quick assets are equal to its current liabilities. The higher the ratio is, the better. An acid test ratio of 1.5, for example, would mean that the company's quick assets are 1.5 times its current liabilities. For Seng Plantation, they have an acid test ratio of 3.52 in 2018. In 2019, they have the acid test ratio of 8.81, and in the year 2020, the acid test ratio for Seng is 6.75. Meanwhile, for IOI, the acid test ratio is 2.35 in 2018, 3.28 in 2019, and 2.11 in the year 2020.
Next, under liquidity ratio is days in sales receivable ratio. So this ratio is used to measure the average number of days that it takes a company to collect payment from their credit customers. It's said that the average of 45 days and below assumed to be a good ratio. So based on the Seng annual report, the company show a shorter collection in 2018, which is 14 days, and increased a lot in 2019, which is 26 days, and decreased a little bit to 25 days in 2020. For IOI, in 2018, the collection days is 26 days, and in 2019, 27 days, and 2020 is 28 days. IOI Corporation collection payment is around the average within these 3 years. However, Seng didn't show a better collection over the year, since 2018 is the shorter among these 3 years. However, these two companies still have a good ratio for the day in sales receivable ratio. The last one under liquidity ratio is day in sales inventory ratio. So day in sales inventory ratio is the ratio that indicates the average time in days that a company takes to turn its inventory, including goods that are work in progress, into sales. The day sales in inventory ratio shows how many days a company current stock of inventory will last. So based on this table, Seng Plantation Berhad start with not a good performance in their day in sales inventory, which is in 2018, when they takes a longer time to convert their inventory into sale, which is 107 days. But over years, they have improved the ratio when the days become shorter in 2019, which is 58 days, and in 2020, 64 days. As for IOI Berhad, they have a good performance in converting their inventory when they committed in decreasing the days in sales inventory ratio. However, both of these companies still not achieve the best ratio for days in sales inventory when they're not achieving the 5 to 10 days of standard good ratio for sales inventory. Next section under this industrial analysis is efficiency ratio. The first efficiency ratio is working capital ratio. Working capital ratio is the difference between a company's current asset and current liabilities. It is a measure of a company's operational efficiency and short-term financial health. Next section under this industrial analysis is efficiency ratio. The first efficiency ratio is working capital ratio. Working capital ratio is the difference between a company's current asset and current liabilities. It is a measure of a company's operational efficiency and short-term financial health. Working capital of Seng Plantations, based on this table, had a massive increment in their working capital ratio and strongly sufficient cash flow to satisfy their short-term debt and operating expenses. However, the working capital of IOI Corporation had increased in those 2 years, which is 2018 and 2019, and slightly decreased for the third year due to the increase of current liabilities, especially on the lease liabilities. The conclusion, these two companies, which is Seng and IOI Corporation, still have a good working capital as long as they have a positive value to cover the short-term debt and operational expenses. Working capital of Seng Plantations, based on this table, had a massive increment in their working capital ratio and strongly sufficient cash flow to satisfy their short-term debt and operating expenses. However, the working capital of IOI Corporation had increased in those 2 years, which is 2018 and 2019, and slightly decreased for the third year due to the increase of current liabilities, especially on the lease liabilities. Next section under this industrial analysis is efficiency ratio. The first efficiency ratio is working capital ratio. Working capital ratio is the difference between a company's current asset and current liabilities. It is a measure of a company's operational efficiency and short-term financial health. Working capital of Seng Plantations, based on this table, had a massive increment in their working capital ratio and strongly sufficient cash flow to satisfy their short-term debt and operating expenses. However, the working capital of IOI Corporation had increased in those 2 years, which is 2018 and 2019, and slightly decreased for the third year due to the increase of current liabilities, especially on the lease liabilities. The conclusion, these two companies, which is Seng and IOI Corporation, still have a good working capital as long as they have a positive value to cover the short-term debt and operational expenses. The conclusion, these two companies, which is Seng and IOI Corporation, still have a good working capital as long as they have a positive value to cover the short-term debt and operational expenses.
Account receivable turnover ratio. Accounts receivable turnover is the number of times per year that a business collects its average account receivable. Accountants and analysts use account receivable turnover to measure how efficiently companies collect on the credit that they provide their customers. IOI Corporation Berhad has lower account receivable turnover for the year of 2018, 2019 and to 2020, which is 1.47 times, 1.48 times and 2.10 times than Seng Plantation Holding Berhad. This result that the company would experience the higher risk not to be collected and indicates that the company has poor in collecting receivables. A low receivable turnover ratio implies that the company should reassess its credit policies to ensure that the timely collection of credit sales that is not earning interest for the firm. Seng Plantation Holding Berhad has higher debtors turnovers, which implies that the company has operated on a cash basis, or the extension of credit, and the company has aggressively in collecting of account receivable that are efficient more than IOI Corporation Berhad. Besides that, a higher receivable turnover indicates that their receivables more frequently throughout the year. Inventory turnover ratio. Inventory turnover ratio is a financial ratio showing how many times a company has sold and replaced inventory during a given period. Calculating inventory turnover can help business make better decisions on pricing, manufacturing, marketing, and purchasing new inventory. For IOI Corporation Berhad, the inventory turnover from 2018, 2019, and 2020 are 3.10 times, 7.19 times and 6.89 times respectively, while its competitor Seng Plantation Holding Berhad shows the inventory turnover from 2018, 2019 and 2020 are only 3.75 times, 4.81 and 4.92 times per year. Declining palm oil export volume, lower demand for palm oil, crude palm oil prices remain sluggish, adverse planting condition and volatile commodity prices are the reason of the low inventory turnover. Fixed assets turnover ratio. Fixed assets turnover is an efficiency ratio that indicates how well or efficiently a business use fixed asset to generate the sales. Generally, a higher fixed asset ratio implies more effective utilization of investments in fixed assets to generate revenue. This ratio is often analyzed alongside leverage and profitable ratio. IOI Corporation Berhad has higher ratio more than Seng Plantation Holding Berhad because of the company has greater efficiency in managing fixed assets investment. Seng Plantation Holding Berhad has lower fixed asset turnover, which indicate that the company has inefficient or underutilization of fixed assets. They said that a lower fixed asset turnover of Seng Plantation Holding Berhad also indicates that the company is not using its asset to a full set extent. This could be due to a variety of factors. For example, they may be producing products that no one wants to buy. Also, they might have overestimated the demand of their products and over-invested in machine to produce the products. That's all. Thank you.
Now we go to the free cash flow. Free cash flow represents the cash of a company generates after accounting for cash outflows to support operation and maintains its capital assets. Unlike earnings or net income, free cash flow is a measure of profitability that includes the non-cash expenses of the company's income statement and includes spending on equipment and assets. A good free cash flow conversion rate would typically be consistently around or above 100%, as it indicates efficient working capital management. For Seng Plantation Holding Berhad, it has RM 67.279 million free cash flow in 2018, RM 79.276 million in 2019, and RM 111.77 million in 2020. Meanwhile, IOI Corporation Berhad free cash flow decreased from RM 928.3 million in 2018 to RM 800.6 million in 2019, due mainly to decrease in operating profit, while the decrease from RM 800.6 million in 2019 to RM 466.7 million into 2020, due mainly to increase in net working capital. Compared to these two companies, Seng can be said efficient in their working capital management compared to IOI Corporation Berhad. Thank you.
Market ratio. Market ratio is also called investor ratio. They are related to firm stock price to earning and book value per share. It is also help the management and indication of what investors think of the company's past performance and the future prospect. In addition, market ratio is the result of the company overall performance and basically, if all these ratios are good, then the company value ratio will be high and the firm stock price will increase. First, we look the analysis type for market ratio. First is earning per share. Earning per share is the ratio of the company net profit to the number of its outstanding share. It is to determine the company's strength relative to others company as well as to track performance. When comparing one company to others, the higher earning per share is considered the mark of the stronger business. For the Seng Plantation Holding Berhad, this increased from 3.64 cent in 2018 to 3.93 cent in 2019 and continue increase to 11.29 cent in 2020. While for IOI Corporation Berhad showed a decrease from 48.7 cent in 2018 to 10.05 cent in 2019 and continue decrease to 9.57 cent in 2020. As conclusion, Hapsen Plantation Holding Berhad is showed a strong performance in business, effective growing profitability from 2018 to 2020. This next is price per earning ratio. Price per earning ratio is used to value the company by comparing its earning per share to its stock price. It's compare the market price with earning to establish whether the stock is overvalued or undervalued. It shows how much investors are willing to pay for the company's share. It's a measure the investor confident in the firm future prospect. The higher of price per earning ratio, the higher is the investment confident, and vice versa. Price per earning ratio higher for company with higher growing potential and lower risk. Company with losing money do not have a price per earning ratio. For Hapsen Plantation Holding Berhad increased from 45.05 times in 2018, 54.2 times in 2019, but decreased to 15.94 in 2020. While IOI Corporation Berhad showed an increase from 9.32 times in 2018 to 42.29 times in 2019, and also increased to 45.35 in 2020. The next is dividend payout ratio. The dividend payout ratio is indicate the proportion of earning that is distributed as a dividend to shareholder. Generally, company will try to maintain a stable dividend payout ratio. This is because the reduction in dividend paid signal negative information to investor, and the stock price normally drop after the dividend reduction announcement. Dividend payout ratio of high growth firms are usually lower as most of the profit made are spent on reinvestment and expansion. For the Hapsen Plantation Holding Berhad, dividend payout ratio is decreasing from 69% in 2018 to 64% in 2019, and it also continued decrease in 62% in 2020, while the IOI Corporation Berhad is increased 42% in 2018 to 80% in 2029, and also increased to 84% in 2020. The second last is dividend yield. Dividend yield is measured the quantum of earning by way of total dividend that investors make by investing in the company. It is normally expressed as a percentage. It can be used to indicate the return earned to share. Dividend yield Hapsen Plantation Holding Berhad is 1.52% in 2018, decreased to 1.17% in 2019, but in 2020 is increased to 3.89%. Meanwhile, dividend yield for IOI Corporation Berhad 4.52% in 2018 dropped to 1.88% in 2019, and also dropped 1.84% in 2020. The last is dividend per share. Dividend per share indicated the amount of dividend received by ordinary share for each unit of ordinary share held. The regard for Hapsen Plantation Holding Berhad, the company paying 2.5 cent in 2018 and also 2.5 cent in 2019, and for the 2020 they have paid 7 cent dividend per share. While the IOI Corporation Berhad, the company paying 20.5 cent in 2018. For the 2019 and 2020, they have paid 8%.
Thank you, Bob. Next is short-term future prospect. So palm oil commodities prices are expected to remain volatile in the new financial year. The market is influenced by both domestic fundamentals as well as uncertainties in the global macroeconomics. This effect of the COVID-19 pandemic in 2020 are still lingering and transforming the world economy. The Hapsen Plantation Berhad prospect mostly depends on the domestic and global macroeconomic factor which affect the palm oil market, weather conditions in oil seeds producing, government policy on biodiesel, and the seasonal cropping pattern FFB. Palm oil production has yet to recover in the first quarters of 2021, primarily due to heavy rain and flooding, particularly in Sabah, which affected harvesting and processing activities. The reimpositions of the Movement Control Order (MCO) in mid-January 2021 has impacted production. However, palm oil production in Malaysia is expected to recover by the second half of 2021. Malaysian palm oil production is expected to reach close to 20 million in 2021 and keep increasing in the future. Coupled with the recent change in export tax structure in Malaysia, which will likely shift demand for CPO from Indonesia to Malaysia, this is likely to augur well for export of Malaysian palm oil. As for the IOI Corporation Berhad, the short-term prospect is more to the impact that are more apparent in the HoReCa sector and to many extent the crude oil prices. This directly and indirectly have resulted in the loss of demand from many major consuming countries. Concern over trade tension between the US and China and more trade protectionism in the worldwide economies have increased the probability of price fluctuation. IOI Corporation Berhad are keeping a positive outlook for the next financial year with the group's fully integrated supply chain business model and continuous drive to explore opportunities to increase value in every level of their operation. Demand is expected to recover gradually as more countries are easing their lockdown and businesses in 2021 and are starting to resume their operation after the disruptions from COVID-19 pandemic in 2020. Palm oil production is expected to remain subdued in the coming years due to dry weather, progressive replanting activities by many farmers, and the inherent labor shortage issue. The low stockpiles at destination market are also seeing many countries starting to replenish their inventories, partly for food security purpose. That's all from us. Thank you.